Welcome to Theo Trade. This is Don Kaufman. July 16th, 2025. We are just about an hour after the cash close here on this Wednesday afternoon. Well, the only statement you can make about the S&Ps on the week is that they are massively unchanged. But there is quite a bit going on kind of beneath the hood of this marketplace, and really two areas that I want to focus on. Number one, unequivocally right now, it's got to be back to bonds. Now, granted, I recognize the bonds also finished at least this trading session massively unchanged. Nevertheless, that is trend worthy. We are getting down to it. And the big question, that I look at in the markets right now is the bond fear going to return? And what I mean by that is, look, we are very close to some of the lowest levels that we've seen, okay, literally in modern history, in that bond market, which in turn says that it's the highest interest rates in many, many years. And I'll actually show you rates here in just a moment. But I want to start with bonds, and I want to look back like over the last 15 years. You look at 15 years, you're like, okay, yeah, I get what he's saying. And then we can look at actually the max chart of the bonds. And we can come in here, let's get crazy. Let's actually go in here and contract, adjust everything, adjust for contract changes, hit apply, hit okay. What do you got? I mean, we're just a hop, skip, and a jump off of bond levels that we haven't been at since roughly 2007. Now, I'm not trying to, draw any conclusions between like, oh, what's going on right now in 2007. That's not my point for showing you this. The point for showing you this is these are pretty serious implications with the bonds at these levels. And we're back down there and we're threatening again. And at some point, okay, something in this market has to matter, right? And people say like, it's okay, AI is going to fix that. Interest rates don't matter. AI is going to fix that. There was actually a scare today that they were going to fire Jerome Powell, but no, we fixed that too. There's absolutely no reality to what is that, some type of a rumor. Anyway, with that being said, now I'm actually going to switch from the bond market for just a second to the 10-year interest rate. And the 10-year, look, it's had levels as high as 4.8. And again, I was looking at the 30-year, bond futures, but now we're looking at the 10-year. And again, just to make a quick point over here, you can go back like 15 years and you kind of get it. This is some of the highest interest rates that we've seen, in any modern history. You can go back over here to the max chart, and you literally have to jump all the way back to literally 2007 to see, interest rates associated with the Treasury that are this high. And again, if you zoom into the 10-year, we're hop, skip, and a jump right now off of 4.5%, which I think is going to be a fairly key threshold. We're actually going to cross through it. So why do I spend the majority of this evening's video talking about bonds? Because at some point, the bonds, once again, are going to spark some fear. The CPI came in yesterday, which is, consumer inflation. Portions of it were actually upticking a little bit. Portions of it, though, were decent. But it's a difficult argument right now to say that, the Fed should cut rates. The Fed cutting rates or not cutting rates, okay, it's kind of a moot point. Who cares if they cut? Oh, no, they're going to have two cuts between now and the end of the year. Two cuts. It's 50 basis points. Who the hell cares about 50 basis points? I'm looking at the ZB, okay, which is clear up to like 5% on interest rate. And look at the 10-year, it's 4.5%. You can cut, and the Fed can cut, but that's only going to cut the very front of the curve. You could still see some sell side activity in this bond market. And that's one thing that I really want to drive home is, look, trade can come in, start selling these bond markets. Interest rates could still explode higher. And we've got some problems. And we're really close, though, again, to the market. All the focus of the marketplace, okay, all of a sudden is NVIDIA. NVIDIA is the greatest thing ever. Oh, I love NVIDIA. Okay, eat, breathe, sleep NVIDIA. I'm being sarcastic over here, but that's the way the market functions right now. And then, oh, Meta. Meta's the greatest thing I've ever seen. Oh, I love Meta. Okay, ain't no love right now for the financials. They're seeing some sell side activity. There's absolutely no love right now, okay, for consumer staples. They've been smacking the crap out of that a little bit here and there. And right now, okay, there's absolutely no love in the bond market. But the bond market is really going to take, as I said, kind of center stage in the days to come. You got to rationalize. We're going to trade, 111, 110, or even pierce the oh so important 110 handle inside of the ZB. You start get through like 110, and that's when markets. There's just no question at that point they're going to start paying attention. They may pay attention if the bond sold off a point from here, threatening like even 111. And I'm telling you, this, as I said, is going to be taking center stage in the markets. You think like, that has no implications whatsoever to NVIDIA. It's not going to matter. What it does, okay, is it lessens the appetite, okay, for both retail and institutional investors in a rising interest rate environment. Okay, what causes sell-side activity in the bonds? Look, it can be bond vigilantes, which is basically people saying there's just too much debt. Okay, other sovereignties that just don't want to hold U.S. debt anymore. I can give you 50 different reasons the bonds are going to sell off. One thing I'm going to tell you, okay, is that sometimes when interest rates get really close to critical levels, like in this case, that 4.5%, it becomes a foregone conclusion that then they're going to trade through it. And that's my assumption right now, is that this 10-year right now is actually going to trade right through. And again, I know it says 45, but that indicates 4.5%, of course, in the 10-year, and that it is actually going to trade through it. All right, so I wanted to cover that and cover it in a little bit of detail because, again, to me, it's the most critical thing going on inside of the S&Ps, and you're kind of wondering, like, where's the appetite to do anything right now? I think the bond market's having a critical effect on that. I mean, overall, what are we seeing inside of the tape? It's an absolute slop fest out there, okay? And it is still a game of kind of musical chairs in the marketplace today. Apparently, we're buying Tesla again. They like me. But at the exact same time, they're selling, as I was talking about a moment ago, Meta. Meta's more than halfway home to the lower edge of the expected move. Amazon saw a little sell-side activity, okay? Microsoft, down 20 cents. Oh my gosh, say it ain't so. I'm not sure this thing has had a down day in, pretty much since the bottom here, of course, in April. Nevertheless, it's musical chairs inside of some of the tech stocks. Okay. Clearly some bigger earnings, not necessarily this week, but coming out next week. There's earnings this week, but the real big boys start kind of kicking off next week. The likes of Netflix this week, but that's not exactly going to be a market moving event. All right, onward. Okay. This week we have approximately, and this is important. This week we have approximately a $90 expected move. And I say, like, look, this is important. And I'm going to tell you exactly why. So the expected move in the SPX is right at $90. And I can't stress enough when I start bringing up $90. Okay. Why do I bring that up and say, oh, so it's so important? It's so important because we're unchanged. And it is very, very rare that you get 2 consecutive weeks, okay, of massively unchanged. Got to realize, where are we right now? We're 1, 2, 3, 4, 5, 6, 7, 8, 9 trading sessions. Your 9 trading sessions with an absolutely identical range. You could even throw in the a few more. So you've got, you're into basically your 3rd week of trade, okay, with an incredibly tight range. A better way to actually delineate this could actually be looking over at the S&P futures market. And let me just kind of zoom in for 1 second and show you, okay, yeah, we jumped to the upside, okay, but right now we're completely range bound. I mean, all the trade, and I do mean all the trade that's happened like the last 12 trading sessions is roughly within a 100-point realm, which is an incredibly tight range. So the reason I say, like, strap in a little bit for the remainder of this week, you don't see necessarily any risks ahead of you. I mean, like, literally, like, if I told you, oh, the market and the VIX, and, oh, the VIX is, where's the VIX? The VIX is 17. It's not going to back off much, okay? Not with the Trump administration in there. But the bottom line is, between now, okay, and the end of the week, we're only expecting like a $52 move. That just doesn't leave a whole lot of price action kind of on the table over there, but a $52 move. But I am telling you, okay, that this marketplace, okay, I'm taking the over on the $52. This marketplace has the capacity, okay, to hit, if you will, a $90 move higher or lower. And as I was saying a moment ago, okay, and then was showing you like just how flat we really are. Last week, and this is important. Last week, we didn't do anything. Last week on Monday, we almost touched the lower edge of the expected move, but that crap just doesn't count. This week, where are we? Absolutely nowhere. Okay, so you really need to anticipate. Let's get ready to rumble coming into Thursday and Friday. There's going to be some volatility. People, this marketplace has got legs, not for any other reason. Okay, there's no risk on the table. Any other reason for the fact that trading in the exact same range. Okay, that expected move is $90. People, there's a high probability you're going to hit just that. Thanks everybody for joining us here at Theo Trade. Have a wonderful evening. Bye bye.